there's a lot of numbers on here, so roll with me, and I kind of need to go kind of fast. So hopefully I don't lose anybody. But the first thing that I always like to talk about is it's good to understand how banks make money, because what we're talking about with Bank Outside the Box ultimately is how to kind of become your own bank, how to be your own banker is what we're talking about here ultimately. And so if we understand how banks make money, that helps us out a little bit. So what we're talking about on there is let's say that you know, a bank pays somebody, a bank's paying Shoney 3%. He deposits some money in, he gets 3% on his savings, and then they're going to loan money out at 9% interest on a consumer loan. So when we just look at that very simply, they're paying somebody 3 for savings, they're earning 9. So as far as the spread, what is that? 6, right? So we look at that and go, okay, the bank made 6% on our money. So, you know, they're getting a good deal there. If we take it a little further, I like to talk about money a lot of times in the form of dollars as opposed to interest rates. So let's say that Shoney deposits $100 into the savings. Okay, so that Shoney's going to be the one that deposits in, and so the bank basically has to rent Shoney's money from him. Okay, so the bank's going to pay $3 to Shoney to rent his money. Now that $100, Susie comes along. We'll pick on Susie since Hunter left. Oh, Susie's still here. Susie comes along and she wants to take a loan from the bank. Okay, and is the bank going to loan out their own money? Their own $100 to Susie? No. Are they going to sublet basically Shoney's money? That's what they're going to do, right? They're going to sublet Shoney's $100 to Susie, and then Susie is going to pay the bank $9 on that subletted money, is what happens. Okay. So again, we look at that and we go, okay, how much did the bank make? $6, right? But we'll go a little bit deeper into that. Okay. If you take a look at what they really made, this was where I got some nerdy calculators on here, so I don't want to lose anybody, but this is an interest rate calculator, right? You guys heard of future value, present value, all that. You learned that in college and high school a little bit, maybe. So that's an interest rate calculator. So what that's saying is that $3 that they paid Shoney as a present value, and then you can see that again, they brought in $9 from Susie from that loan. If you figure out what the actual interest rate on that, it's 200%. So that's it says they've got a $6 gain, but it's really a 200% profit to the bank. Think about that for a second. That's a lot of money, right? That's a lot of money. That is exactly why banks and banking is the largest, most profitable industry in the world. Is that? That's why they have all the big buildings, and they can loan money out like crazy and loan it to all your clients. Okay, so that's how banks make money. So the question is, you know, what are some thoughts and ideas that we can do with that idea? In other words, what if we wanted to try to be the bank a little bit? So just a couple thoughts. Let's say that we had a grown child that had a credit card at 22% interest, okay? And we wanted to help them out, okay? High interest rate. And so if we could go access money at 5%, so we could go pay somebody 5% for some money. So we had some money accessible to us at 5%, okay? And let's say we went and paid our daughter's debt off, and we now just charge her 10% instead of 22 that the bank was charging her. So we're doing a nice thing, right? Helping her out. So we pay somebody 5, we bring in 10. What's our rate of return? Looks like 5, right? It is. It's 5% spread, right? But when you take it down there, it's 100% return on our money. Even though we borrowed at 5, we're bringing 10 in. That's literally 100% return on that money. Okay, that's what the banks do. One other thought, you know, hard money, right? You guys are familiar with that world. Okay, hard money. Let's say that we wanted to go participate and be like a hard money lender or something, whatever, right, on some deal. Okay, let's say we could access some money for 5%. Okay, that was our cost to get the money. and we loan that out at 14% interest on some deal with somebody. Okay. Again, the spread looks like what? About 9. Okay. But our actual profit on that deal is 180%. Okay. So we just have to think like the banks a little bit if we want to be like the banks, and we got to do things like what the banks do. Okay. So here's a couple, we're going to talk about how people finance things. And this could be, I don't care if it's cars, houses, whatever, just financing large things. There's 3 types of people. There's the first one's a debtor. So we'll call this, that line is the 0 line. That means that's somebody who has no debt and no assets, just 0 net worth. Okay. If they went and bought a car, this is how they do it. Do I need to look over there sometimes? I feel bad, guys. Like, are we okay? Okay. So they go take out the loan at a bank for the car, and then they make payments back to a bank with interest over a 5-year period or whatever it is. And then it's time to get another car. So they go take out another loan, make payments back again, principal and interest back to a bank, and then just continue to do that over and over and over the rest of their lives. Okay, that's what we call a debtor. Okay, so we can see they take loans, they pay people interest, and the worst part is they end up where on the 0 line? They just stay on it, don't they? They're not getting ahead. Okay, the next person is the saver, or the person who uses cash. So they're like, hey, I'm smarter than the debtor. I'm going to use cash for things. I don't pay interest to people. Okay, I don't pay interest. Okay, so here's how they do it. They first save the money. Okay, and what's important about that is compounding interest too, right? While they're saving the money, if they're not touching it, interest builds interest. Okay, so that's good. Okay, so they save it ahead of time, and notice they're also making payments, though. They just do it ahead versus after they get the car. Okay, but they are making payments, and then they're having that compound interest occur. But when it comes time to make the car, or to buy the car, what do? They've got to deplete the pile, so they interrupt that compounding interest at that point, and they go pay cash for their car at the dealership. Okay, and then it's time to upgrade their car. Well, first they've got to save up again, refill their account so they can get their next car, and then they go do that, right? They go buy their car, and then they just do that over and over again for the rest of their lives. Okay, so they're both making payments in both scenarios. One's earning interest, the other one was paying interest. But the most glaring thing between the two is what? Where do they end up on the 0 line? Stay at 0, right? So the third person we're going to talk about is we're going to call them a wealth creator. So wealth creator is going to kind of use a combination of both things. So what they're going to do is they're also going to save money somewhere. They're going to build some money up. And what that line represents is their savings account, or wherever their money is. And it's compounding interest, interest building interest. But what they're going to do is when it's time to buy the car, they're not going to pay cash for it. What they're going to do is they're going to take a loan out against their savings. Okay, so they're going to use their savings as collateral. And then they're going to pay back somebody principal and interest. So they are paying interest to somebody in this scenario. Okay, and then when it's time for the new car, they do it again. But you notice what's happening. They're not what? With the savings, what are they not doing to that? They're not depleting it, right? So that compound interest continues to go. And then they continue to do that throughout the rest of their lives, okay? They still have debt, they're still making payments, they still have interest they're paying to somebody, but what happens to their assets? Continues to grow. So they finally get off the 0 line, right? They actually build wealth, okay? So that's what we're talking about. When we talk about like bank outside the box and things like that, we're talking about getting our money in motion and having our money do multiple things at once, right? Because isn't my money, if I've got it growing on one end and then I'm able to use it to go buy my cars or my house or whatever, I'm doing multiple things with the same dollar, okay? And that's one of the things that we want to accomplish. So bank outside the box process, okay? So this is the high view of the high view of how this works, okay? So there's a person up there. So what they're going to do first is one of the products that we use inside of this thing is called a participating modern whole life insurance policy, what it is. And we'll get into that later, what that is. But the person is going to first fund or put savings into the policy in the form of premium. Okay. Those premiums are going to have minimums and maximums that are very, very flexible. Okay. Especially for people who have incomes that go up and down, you know, and cells and different things. It's nice. Okay. Once they put that money in there, part of that money goes and purchases a death benefit. And then the rest of it drops down into what they call cash value. So in that cash value bucket, the money is going to grow inside of there. It guarantees the principal. So your principal can never go down contractually. It also guarantees a certain amount of growth every year in it. And there's also a non-guaranteed dividend that gets paid into that. Similar to Keller Williams with these companies that we use where they pay back part of your profits to you guys. The companies that we use are called mutual life insurance companies, and all of their profits actually get paid back to policyholders in the form of dividends. So when they're making decisions for us as policyholders, not their shareholders. Okay. So what's nice about that is it allows you to do some planning, right? If I'm trying to say like, hey, I want to do, Jenna came up today and she talked about being in the business 100 days. I said, oh, you're looking at days, right? And it's like, yeah, we do that, you know, this many, this day, this, you guys are planning around here, right? And when somebody says like, yeah, I want to have X amount of properties in the next 5 years, I want to do blah, blah. This is a great way to know exactly what's going to be there for you to actually be able to plan because of those guarantees. Okay. So, and there's also some tax advantages in there. Once the money gets in there, it grows tax deferred, so you don't pay any taxes on it. And 2 of the 3 ways that you can access the money are tax-free to get your money. Okay. All right. So now we're going to go make our purchase. We're going to go buy a car, a house, pay for our kids' college, whatever you want to pay for. Okay. Whatever you need to pay for. So the way it actually works is what's going to happen is the life insurance company that you have that policy with, you're going to request a loan from the life insurance policy. And it's pretty easy. All of you guys have gotten loans before for houses and other things. This is way easy. You send in a 1-page form that you sign, and they ACH that thing back to you in 5 to 7 days. They don't ask you if you have a job, if you have income. They don't look at your credit score, nothing. Super, super easy. Easiest money you'll ever get, okay? So they're going to give you this loan, and you're going to go pay cash with that money, the loan, for whatever you're going to buy. And then what you're going to do is you're going to make payments back to the life insurance company, principal and interest. They are going to charge an interest. The companies that we use average about 5% interest for their loans is the average, okay? So you're going to pay principal and interest payments, and you're going to treat that just like you would treat any other purchase. Because part of this thing is, one of the cons of this is not having discipline. You can't just, because all of a sudden you built this thing, go, hey, I'm going to go buy a brand new boat, if you couldn't normally have afforded a brand new boat. That's not what this is. It's not free money, okay? So you're going to make principal payments back. And here's the nice thing about it. The only thing that the life insurance company doesn't care how fast you pay it back, how often, if you want to take time off. Think about that with a piece of property, right? Think about 2020, right? With the moratorium, where there were a lot of states, it was like, hey, you don't have to pay your landlord right now. Well, the landlord has a mortgage to pay. What are they going to do, right? If you'd financed the property through this process, you could have just not paid payments during that time period. Nobody's going to say anything to you. Okay, a lot of value there to have flexibility over the borrowing and the payments back. Okay. Now, the question is, why is it so easy to get the money, and why are the terms so flexible? Okay. Reason is what the insurance company did when you asked for that loan. They went over and looked at your cash value. And they said, okay, they've got this much cash value in there. They're asking for this much loan. We're gonna collateralize their cash value and put a lien against it. So that's what they did. They put a lien against the cash value. So what that means is, what they know is if this individual walked away and just canceled their policy tomorrow, it means that the individual would get their cash value minus the loan and interest that they owed to the insurance company. So the insurance company is guaranteed to get their money back. And then the other thing would be if the person died. Well, if the person died, the life insurance company is going to take their money first to pay off the loan and interest, and then the remaining will go to your heirs. That's how that gets paid back. That's why it's so easy to get the money, and it's just so flexible. I was just talking to Hunter earlier about this, the flexibility and stuff. The other nice thing is those loans are guaranteed. So you know, when you think about, like, I don't know how long everybody's different time periods in here, but when we were doing a lot of stuff with properties back in 2003, 4, 5, 6, 7, you know, a lot of people, you know, they had these HELOCs they were using and everything else. Guess what the banks did when 08 hit? What did they do? Shut them off, didn't they? You guys remember that? They can just go, hey, you got a $100,000 HELOC, you owe 40, we're shutting you off at 40. You're done. You can't access anymore. Okay, that can be a big problem if you've got plans, right? With this, it's not an issue. Okay, I gotta get a drink because I normally do talk this much, but for some reason. Okay, so we are gonna have a quick Q&A at the end. So remember your question. So why whole life insurance? I'm gonna kind of skip through that. We talked about the guaranteed principal, guaranteed growth. You can access up to 95% of whatever's in the policies to go borrow against. Growth and loans are tax sheltered. This is a big one, locked in cost structure. And we actually had this question in a, can't remember what the meeting was called last week or two. Pete, what? ALC. Was, you know, does the insurance cost go up inside of these things over time? And there are certain policies that they do. Policies we use don't. They stay locked in, the insurance cost stays level. So as you age, get into your 60s, 70s, and 80s, the insurance cost isn't just going up on crazy and you're losing all your money. It stays the same, okay? We use large A+ rated insurance companies. And I always tell people, they're like, well, why haven't I heard of this or whatever, right? These companies, they don't necessarily promote this. We're basically taking products and ideas. We're building the way we want to build them, using the way we want to use them, and it's allowed within the spectrum of what the insurance companies allow. But they're not necessarily out there, you know, promoting this. Okay. Here's what a modern policy looks like. So there would be like that's your guaranteed base premium as it goes in. It stays level, it never goes up. You'll have a death benefit that continues to rise. You'll have a guaranteed cash value. Contractually, you can't even read that, but there's some dividends that you'll get on top of that, profits from the company. And these companies that we use, they paid their dividends for the last 150, 200 years they've all been around. So, and then there's a special rider called a paid up additions rider that we use inside of these things that really kind of puts everything on steroids as far as the cash buildup and getting a lot of money in there in the early years. Okay. Yeah.
These are cheaper loans than when you get to the bank also.
Depends when, right? So if it's 5% now, you just got to say what, you know, what is it now on whatever you can get elsewhere. So
I was just wondering if, you know, if you're adding also the premium into that, you know, aside from your principal and interest payment to everything, how does it then compare borrowing it from the bank?
well, I'll show you. So a big part of it is that your initial cash continues to grow. Where if you just go get a loan from the bank, you just get a loan from the bank. So what we're going to compare here in just a couple minutes is I'm actually going to compare buying a piece of real estate using cash or using this. It'll answer some of that. Good question though. Okay. One of the things we do with these policies though is there's a thing called a modified endowment contract. Basically, back for a long time, you could shove as much money into these things as you wanted to. And have a low death benefit, shove a ton of cash in and take advantage of all these these tax advantages. The IRS, obviously, they sniffed it out once upon a time in the early 80s. They figured it out and they put some limits on how much we can shove in per amount of death benefit is what they did. That's what the MEC limit is called. So basically, we don't want to go above that line. Otherwise, everything becomes taxable and we lose that tax advantage in the cash values. Okay. So if you were to look at this with different life insurance policies, the least amount of money you could put in per death benefit would be like term life insurance. Okay. And then traditional whole life insurance. And then we build our policies right up to that MEC line. So we try to build that cash. The idea is the higher up you are, the more wealth building, the less death benefit. We're trying to build a lot of cash and limit the death benefit is what we're doing. We're not buying it just for the death benefit. Okay. Compound interest, we've talked about that a bunch. And so now we're getting into, we're going to go do that comparison right now on the house. So if that was our pile of money, let's say that was our cash value, right, in our life insurance policy. And we built up $550,000 in there. We've got that much cash value in there. Okay, we're going to go buy a property long-term rental for $500,000. Sounds like they're not selling very well right now, according to the gentleman earlier, but that's what we're going to do in this scenario. So, or to somebody said that. Anyway, $500,000 is what we're going to do. Now, what we got to remember is because we took a loan, this is what we were just talking about, because we took a loan against the cash value, our cash value continues to grow that whole time. It doesn't stop, right? And interest is building interest. That's what Einstein calls the eighth wonder of the world, compounding interest. Okay, so it never ends. Whereas if we just had cash and we used it, then it would interrupt that compounding, right? And we'd have to start over. Yeah. It's going literally to the bank. Nope. Yep. And here's the excitement, guys. Where is our lady, the blonde head lady up here, man? She would have just made this so fun right here. I can't make it fun. We'll try to make it fun. So we're going to buy that property. We're going to just show two examples. There's a bunch of examples I can show you guys, a million ways when it comes to buying property, different properties, different. We can talk about rate of return on cash. We can talk about, there's a dozen different ways to do this. I tried to pick the most simple way just to entertain today. So what we're going to do is on that side, we're going to talk about just paying cash for this property. And then we're going to first talk about that. And then we'll flip over and talk about using the bank outside the box, meaning the policy loans on that side. Okay. So if we paid cash for the policy, let's just say that purchase price is $500,000 is what we're going to pay for the property. We had to pick amount of time to look at this. So we just picked 20 years. So we're just going to take a 20-year time period. Just assume we own it for 20 years and sell it at 20 years or whatever. Okay. And then our monthly rents, we're going to put $3,500. So it's probably a pretty nice $500,000 home for $3,500 a month. Okay. Maybe an Airbnb. I don't know. Okay. We're not going to consider depreciation, cost segregation, taxes, insurance, any of that on this. We're just going to look at straight up. Okay. So what we're going to look at here is we're just going to say, what is our total value in dollars at the end of this 20 years? What, by paying cash for it, what's our total value? So what I did is I said, okay, let's figure out what the future market value would be. Well, this could be obviously anything. Here's another nerd calculator. So future value calculator, we take $500,000 and I just put 3% as the growth rate. Obviously, it can be higher than that, a lot lower than that. It can be all kinds of things. I just threw in 3% for us to look at over 20 years. And then, so the future value of that is 900,000, just over 900,000 bucks. That $500,000 is worth 900 at the end of 20 years. You guys with me so far? Okay. So, then the next thing we're going to look at as far as values goes, what's our total cash flow, right? This is what Robert Kiyosaki term and everybody else nowadays focus on cash flow. So the cash flow, to figure that out really without bringing a calculator up, we take what? The $3,500 a month times it by 12 months. I think that's about $42,000 a year. And then we take that $42,000 a year times it by the 20 years that we're talking about. Okay. And when we do that, it's $840,000 is what we get. Okay. So our total cash flow that comes into us, $840,000 off that property, if everything stayed just like that. Okay. So to figure out what our total net value in dollars is, we have to take out the purchase price from that, the $500,000. So our total net value, when we add those two, take out the purchase price, $1.243 million. Okay, so you guys are all real estate people. Does that look like a good deal? I'd take it. It's a pretty good deal, I think. You think it's a good deal? I can't tell. She's like, got this. Yeah. Okay. But it is a good deal. Okay. So she's leading me there. So now we're going to go over to policy loans. So policy loans, we're going to have the same market value. It's the same house. We're talking about the same exact house. So it's going to be worth $900,000 at the end of 20 years. Okay. Or whatever the number is. Total cash flow. This is where it's going to change a little bit, because remember what we did to get here is what? How we paid for this is we took a $500,000 policy loan against our cash values to pay for this. And at 5% interest, so basically you take a calculator, you say 500,000 is my loan amount 5% is my interest and amortize that over 30 years like a fixed payment. Okay. And what that number is $3,223 a month payment back to the insurance company, whoever asked that over there. It's going to the insurance company, principal and interest, not to me, to the insurance company. Okay. So it goes to those guys. And when you look at this kind of stuff online and stuff like that, you'll hear a lot of people out there go like, yeah, get all your, your interest back and everything else. They don't know what they're talking about. That's not what actually happens. It goes to the insurance company. Okay. So that goes to the insurance company. So now we go, okay, well, we've got to subtract out our payment to the insurance company. So our net cash flow per month is $277 in this scenario. That's what we get every month. Okay. So again, take 277 times 12 months and then times that by 20 years. And that gets us to $66,000. That's our cash flow. Okay. So if we were looking at that, most of us would stop here and go, all right, I think I know which one's the better deal, right? Looks like at this point, looks like the cash is a better deal. But there's something that we're leaving out. What's that? So our original $500,000 inside the policy, it never got interrupted, right? That cash value, it grew that whole time, right? So we get to count that value, right? So if we took the $500,000 and just projected out over 20 years at 5%, okay, 5%. What we'd end up with, the future cash value would be 1.326 million. Okay. But to be fair, we're not going to count the $500,000, the initial principal. That would be fair to count that. So we subtract that out of there. Right. Okay. So now we come up with our total net value of just short of $1.8 million in our pocket. So then you can say, okay, well, if you take the 1.8, subtract the 1.243 on the cash side, the difference is over $550,000 positive to using a policy loan. Other people's money, right? You guys are familiar with that. Isn't that interesting? And like I said, there's a dozen ways I can show this thing, rates of return, using it for down payments, not buying the whole property, just how you can enhance. Anyway, so yes.
That's the future tax value.
So my policy originally had $500,000 the day that we bought the property. We took a loan against it, so it never left. And if I take that $500,000 and let it sit and grow for the 20 years, it was worth 1.3 million. But I'm going to subtract out the original $500,000 that grew it and not count it to be fair. So that's.
Yeah, so theoretically, borrow that $1.3 million. That's. Yeah.
Oh yeah.
Borrow against it. How liquid?
Super liquid, 95% of it, whatever it is at any given point in time. So earlier I showed how you have the cash value and then collateral down there. So as an example, if we had 1.3 million, if that was our current cash value in the policy, right? And I took out a $500,000 loan, I still have basically the rest of that to go borrow against. What if I paid back $200,000 tomorrow? I have a new $200,000 available. It's just like that. It's super flexible. So as soon as I pay back $1, that dollar is available again to go borrow against and do it again. So when you think about, buying multiple properties at a time and other things like that, somebody might say, instead of putting $500,000 into one property, they might split that up at $80,000 into several properties as down payments to leverage. And they get one paid off and they can immediately go back and take, but the insurance company doesn't look at like separate loans. Remember I told you when it comes to paying it back, you literally send in what you want to send in when you want to send it. They're not like, you need to pay us $3,220. They don't say that. It's us and our amortization schedule that we have on our computer that's telling us what to do. Like we decide. So yeah, in this instance, you could say, well, maybe, some people might go, well, I'm not even going to pay the full 3,000 back. I'm going to pay 2, increase my cash flow for this reason. I mean, you can do whatever you want. It's up to you. Did that answer your question though? It's like one giant loan to the insurance company. They don't look at it as separate loans. When you take a loan for $500,000, then another one for 200,000, then another one for 100, it's one big loan to them is all it is. And so if I have $700,000 worth of loans to the company and I paid back 50 tomorrow, that 50 would immediately be available to borrow again. Yes.
Credit, is that cash value? How much of that is cash? If I wanted to like all that out and buy it.
All of it. All of it. 100% of it. But if you did just, yeah, you can get to the, if the $500,000 that we're talking about, if you didn't want to take a loan against it, you just wanted to dump the policy and take it out, you could. What you'll do though, is if you just, when you cancel a policy, they will, you will pay regular income tax. So you'll pay long-term capital gains on the difference, just like any other investment. So if I put in 200,000, it's worth 5, and I just cancel the policy and take my 5, I'll have tax owed on the difference, the 300. That's how it works. What happens when you die is your death benefit, if you remember, your death benefit's always going to be larger than your cash value, and your cash value is always going to be larger than your loans. So what that means is at any point when you die, there's going to be significantly more money than your loan. So if there's $10 million of death benefit and you have a $500,000 loan, it'll pay off the $500,000 of principal and the interest that you owe on it. And then the family gets the other 11.5. The rest of it goes to the family. Did that answer your question? Oh, taxes? Life insurance is tax-free, income tax-free. Death benefit has nothing to do with anything. That's the reason why that loan is that access to that money. Think about it. And in our industry, everybody's like, they like act like this is magic. Are you ever going to pay taxes on a loan that you take out for anything? You're not going to be, no. It's the same thing here. It's just a loan. That's why you don't pay taxes on it. It's not magic. And then the death benefits are tax-free. So that's why that comes through tax-free.
So how long does it take to say $1 billion? Like, can you give us some examples of how much?
Yeah. So yeah, that's a good question. So one of the cons. So and you know, Shoni knows this because he's 4 years into some plans. One of the cons is of doing this is you don't have all your money available from day one that you put into it, right? There's costs. It's just like a piece of real estate. It's typically not going to be profitable to you the first day that you buy it, right? It's going to take some time. A business, you build a business, it takes some time to become profitable, right? You invest in it. Same thing with these. Typically what you'll see, the way that we build these is you'll typically have somewhere between 70 and 80% of what you put into it that first year. So if I put 100 grand into it, I'll typically have somewhere between $70,000 and $80,000 in there to access. Okay. And then each year it becomes more and more and more. And so typically, so one of the cons is it might take you 5 years to break even on the total amount of money. So if I put in $50,000 or $500,000 in 5 years, I might now have my full 500,000, and then it just gets bigger from then on out and always larger. Does that make sense? So there's a guaranteed growth that the company puts in the contract, and then there's the non-guaranteed dividends. And so if you looked at that, back in the late 90s when I first started, they were paying somewhere between 9 and 12% interest with those interest rates the way that it was back then. Today, you'll see that there'll be somewhere between 4 and 6 is what they're growing at. Yeah, it follows short-term interest rates. That's what's kind of cool about as your mortgage guy standing up here and everybody's going, oh, interest rates, right? Because it sucks right now. We love short-term interest rates when they go up because the way they pay, it follows that. So, but it's usually trailing 4 to 5 years behind because of the way the insurance companies invest their money in bonds and things. So it kind of trails it. So if interest rates still stay up where they are now and they kind of continue up a little bit or stay for a few years, all of a sudden that 4 to 6 is going to go 6 to 8 kind of a thing. At that point is how it works. So, but even I tell people, even if it was worst case, even if it was like 4% is all you got, kind of like your worst case, your difference on there is still going to be at least $450,000 in that scenario. You know what I mean? Even if it was 4% instead of 5. Yes.
You have an example that shows buying term insurance for investor difference and also something that takes into account the claim value of private obviously the net value of the numbers are grossly different if you get $1 in 20 years versus $1 now, depending on the interest rates, the discount rate.
Yeah, you and I could sit on a Zoom meeting for hours and discuss that stuff. I don't have something right here for this purpose today, but yeah, we could spend a ton of time talking about that. And I got all kinds of ways to prove this, prove that, and the other. And depending on who I'm talking to, some people agree, some people won't. But yeah, so, but good question. But if you want to talk, I'm happy to talk to you away from here about all that kind of stuff. Any other questions? We're about out of time. Yeah.
Interest rates charged back.
Well, right now, the ones I use are at 5%. So whatever you guys are getting in your loan world right now, it's probably better. You know, 6-7 years ago, when you guys were getting 3% interest rates, you know, that type of stuff, 4% interest rates, mine was higher at 5% at that time. So you can use the same concept by taking out a loan at the bank and still have that cash value in there, because you're not technically in debt if you have that cash value that you can pay it off at any point in time, right? So if you can get much better interest rates, go ahead and go to the bank and get the better interest rate at the time. And you'll still use the concept's the same. Does that make sense? But a lot of our clients don't do that because of ease. They don't like dealing with the banks. They don't like whatever. So when they build a big enough policy here, they don't have to deal with the banks, and they're okay with that.
Jeff, one of the big things too, that's a big key in this is the difference between like a mortgage loan is going to be on an amortization schedule, where the bank is charging heavy interest upfront, where it might be 60 right now. I think it's closer to like 80% of the initial, 5-year payments are going towards interest, 20%, 25% going towards principal. Whereas with this, it's a simple interest, not a compounding interest like that, not an amortized interest schedule. So you actually have the majority of your money going back towards principal, not just the interest. So it's actually not the same if it's a 5%, 3% rate.
Yeah, it wouldn't be exactly the same for sure. So, and the other things to look at, like a loan here, that doesn't show up on your personal financial statement when you go to get loans. This loan does not. A mortgage would, right? A HELOC, they can shut it down on you any minute. They can't with this. It's just maximum flexibility. The other thing is you can, so it's kind of cool because you don't have to put that loan as a negative balance on your financial statement, but you also get to count your cash values as a positive thing on your financial statement. Yes.
On this policy, you're paying premiums also?
Yeah.
What would, I don't know.
Premiums are all dependent. It's cost prohibitive on these things for somebody. Typically, people are putting in at least about 10% of their income, the way they look at it, into these type of things. You're not going to be able to put in much less than like $300 a month starting a policy. So if you're somebody who's like, I got $50 a month I can throw in here, this is not for you at that time. There's going to be a minimum and a maximum that go into it. So if the maximum is 30,000, your minimum might be 10,000 a year, maximum is 30,000. You can do anything in between the two. So there's some flexibility in it. Okay. So premiums are case by case. When we work through it and see what you're trying to do, what assets you have, because there's not only is there just premiums going in every year, but you can also chuck lump sums in. So some people have some extra savings they want to kickstart it with. There's a lot of different variables. So I guess the simplest thing I can say is it's tailored to the individual on what they have available and what they can do, and it's flexible. Is what it is. And then typically those premiums, you want to be able to pay those premiums the minimum for about 7 years, and you can actually stop paying it altogether if you wanted to after 7 years and just let it sit and grow. So it could be like a 7-year plan if you wanted it to be like that. We like to build them so people can put in longer, because usually what happens, they get to the 7, 8, 9 years and they realize how well it works and how much they use it. They want to keep putting money into it, but now all of a sudden they're 8 years older and everything's more expensive because you're older, because there's life insurance. So, and we'll write these, we'll set these policies up. You could do it as early as like 18 years old, and probably the oldest individuals that we write these on are about 65. After 65, it becomes not as valuable to them to use this. But what they can do if they choose to is they could write it on kids and grandkids and still own it, control it, and do all the same things that we're looking at here. So does that give you any clarity? Okay. Anything else, guys? Okay, so just to wrap it up, I think, oh, I got to go through this really fast. Sorry, we had more stuff I'm not going to go through, but I'm just going to skip through it. Oh, there we go. So this thing, I don't know if I said his name right, Ritz. Love that guy. He made this little thing for me. So if you click on that thing, I guess it takes you to my calendar and you can schedule a Zoom appointment with me and talk to me and ask these any other questions that you guys might have. So you're welcome to do that. So appreciate your time. And again, ultimately at the end of the day, this concept is not to replace what you guys are already doing with your real estate or the other ways you finance things. It's to simply enhance it. That's what this is. It's an enhancing tool to make everything work better, give you a little more wealth, give you some more death benefit for your families. It enhances all of it. It's not to say do real estate or do this, or it's here's your bank, go do real estate, go do Bitcoin, go do your business, go. It doesn't matter what you do with the money. The insurance company doesn't care. It's just a way to enhance all of it and to basically build your own bank. Oh, one more?
Yeah, that's good. I guess.
That's Shoni.
My biggest concern or question would be like, how long is this gonna last? Like, is this gonna be something that could fail in, 10 years or
This has been around for what, 2-3 years now?
2 or 3 years? Yeah. No. So what you care about is not whether I'm around or whether the process is right, because you can duplicate the process. What you care about is the contract with the life insurance company. That's what your contract, that's where your money's held. I don't hold your money. The insurance company does. So we use A+ rated companies. All the companies we use have been around at least 150 years, some of them 200 years. So they've been through all the Great Depressions, they've been through the Civil Wars, and they've actually paid dividends during all those times too. You can look at their historical dividend pays. So these are large insurance companies that have been around for 200 years that we use. That's who you have your contract with. So I don't know if there's much better place to put your money than that, to be honest with you. But that's the answer. So good question. Thanks, guys.
Give them a hand. One little snippet before lunch. So this was actually something that was brought to my attention by some great mentors. And there's been people at different events that I ran into who are putting $500,000 to $1 million into policies like this to fund their real estate investment journey. I started it 4 years ago. And for me, it has been one of the game changers when it comes to flexibility. So I bought multiple properties with my policy. I've seen the speed of getting that cash. I've done a vehicle with it as well. But the biggest thing is that my money is not interrupted. And so that's the big key is over time, it always beats out the strategy of just going straight cash or going and getting a loan because your money is uninterrupted. And as Einstein said, that compounding interest is the 8th wonder of the world. So if nothing more, study that. There's a great book called The Wealthy Banker. And that would be a book that I'd recommend you dive into that goes through this policy or structure or through this kind of philosophy as well. So have a great week. There's lunch and enjoy it.